Hi students, welcome back to economic class. Today in this video we are going to learn national income aggregates related with the national income. So we can discuss the first topic, that is domestic income and domestic product. So in macroeconomics, this domestic income and this domestic product are identical to each other. That means both are equal. Domestic product is equal to domestic income. Then how it is possible? We can check it. So in the case of two-sector economy, so in two-sector economy, who are the sectors? First one, that is household, and the second one it is firm. And here firms are producing goods and services by using factors of production. From where they will get these factors of production? Household. So what are the factors of production? Labor, land, capital and organization. So by using this labor, land, capital, organization, firm is producing some level of output. For example, suppose they produced 50 rupees commodity. 50 rupees commodity. So after this production, definitely they will sell this commodity and they will get how much rupees? They will get 50 rupees. So in the second stage, after the production is the first stage, and in the second stage, firm need to distribute the revenue for these factors of production. So what are the revenues of these factors of production? For labor, it is compensation of employees. For land, it is rent. For capital, it is interest. And for organization, it is profit. So firm need to distribute factor incomes, or firm need to pay factor payment to household. So from where they will pay? From this rupees 50. For example, compensation of employee, that is 10 rupees. Then rent, it is also for example 10 rupees. Interest, it is also 10 rupees. And the profit, it is 20 rupees. So this is known as, what is this one? Compensation of employee, rent, interest, profit. That means sum total of factor income. Sum total of factor income which is generated within domestic territory is known as domestic income. Domestic income. At the same time, the value of output which is produced by the producing sector or firm is known as domestic product. Value of domestic product. So here value of domestic product is 50 and value of domestic income also is equal to 50. So both are equal. So that's why domestic income and domestic products are identical to each other. We can write it as domestic income is identical to domestic product. This is a symbol of identity. Identity means which will be equal always. This domestic income and domestic product will be equal always. At the same time, yesterday we discussed how we can convert domestic income into national income. So how we can convert? By adding NFIFA. What is NFIFA? Net factor income from abroad. How we can calculate NFIFA? NFIFA is equal to FIFA minus theta. Factor income from abroad minus factor income to abroad. So domestic income plus NFIFA, that is equal to national income. Like that, domestic product plus NFIFA, then what will be equal? That is equal to national product, because domestic income and domestic products are equal. Like that, national income and national product will be also equal. So domestic product plus NFIFA, that is equal to national product. So from this part onwards, instead of calculating domestic income and domestic income and national income, we will calculate domestic product and national product. Domestic product and national product. And here keep in mind this domestic product is equal to domestic income and national product is equal to national income. Got it? So coming to our next topic, that is gross and net concept of domestic product. Gross and net concept of domestic product. So domestic product is calculated as gross domestic product, that is GDP, and net domestic product. Gross domestic product and net domestic product, GDP and NDP. So in previous lesson we studied gross investment and net investment. Gross investment and net investment. So how we calculated this net investment from this gross investment? How we calculated? Net investment is equal to gross investment minus depreciation. What is another name of depreciation? Consumption of fixed capital. So gross investment minus depreciation, that is net investment. Then from this net investment, how we can calculate gross investment? That is net investment. Here it is minus depreciation. Then what will become? Net investment plus depreciation. So the difference between gross and net. Difference between gross and net, that is depreciation. Keep in mind the difference between gross and net, that is depreciation. So here also same thing is the gross domestic product and net domestic product. So if we want to convert the gross domestic product into net domestic product, how we can convert? Net domestic product is equal to gross domestic product, that is GDP minus depreciation. If we subtract depreciation, this G will change as N. Then we will get NDP. NDP is equal to GDP minus depreciation. And next one, from this NDP we can calculate GDP. How? GDP is equal to NDP plus depreciation. NDP plus depreciation. So keep in mind the difference between gross and net, that is depreciation, and the difference between domestic and national. Domestic and national, that is NFI, FA. If we want to convert domestic product into national product, we need to add NFI, FA. If we want to convert national product to domestic product, we need to subtract NFI, FA. If we want to convert gross into net, we need to subtract depreciation. If we want to convert net into gross, we need to add depreciation. Hi students. So coming to our next topic, that is domestic product at market price and domestic product at factor cost. Domestic product at market price means the total amount of goods based on market price, or the value of goods based on market price. And domestic product at factor cost means total product or value of goods based on factor cost. Factor cost means cost on factors of production. Okay, so in the case of two-sector model, this domestic product at market price as well as domestic product at factor cost are equal. Both are equal. There is no any difference between domestic product at market price and domestic product at factor cost. Both are equal. So we can explain with an help of an example. That means, as per previous example, suppose a producer individual A, he produced some amount of commodity, for example rupees 50 commodity. Then after the production he need to distribute compensation of employee, rent, interest, profit to the factors of production. So 10 rupees as compensation of employee, 10 rupees as interest, and 10 rupees as rent, 20 rupees as profit. So actually he produced 10 unit of X 10 unit of X, and the price of this 10 unit of X is, that means the price of commodity X is 5 rupees. 10 unit of X is produced and the price of 1 unit of X it is 5, then the value of this 10 unit of X is equal to rupees 50, and this is known as, this rupees 50 is known as domestic product at market price. So it is based on market price. Price is 5 rupees and we multiplied with the number of output and we got the value of our output, that is 50. Okay, at the same time, this compensation of employee, interest, rent and profit. So it is an income for the consumer, or it is an income for household. From the side of producer, whether it is income or cost, from the side of producer, it is a payment, factor payment. So it is a factor cost. Okay, so GDP or domestic product at factor cost means 10 rupees is the cost from the side of producer as compensation of employee. This 10 also the cost of production, this 10 also cost of production, this 20 also cost of production. So domestic product at factor cost. Factor cost means payment made on factors of production. How much it is? 50. So this 50 is known as DPFC, that is domestic product at factor cost. So in two sector economy there is only household and firm is there, and in two sector economy these both are equal, that is domestic product at market price, that is 50, and domestic product at factor cost, that is also 50. Both are equal. But when we come to the third sector model as well as fourth sector model, so in third sector model, which sectors are included? Household, firm, government. Fourth sector model, household, firm, government and rest of the world. So in third and fourth sector model, both will not be equal, both will be different. Okay, the main reason is that in 3 sector and 4 sector model, there is government is there. So in 3 sector and 4 sector model, tax and subsidy, they will play their role. As a result, what happened? This domestic product will not be equal to domestic product at market price, will not be equal to domestic product at factor cost. We can explain with the help of example. Okay. Here tax means, what is tax? It is a compulsory payment made by individual to the government. Tax is divided into two, direct tax and indirect tax. Direct tax and indirect tax. So example for direct tax, it is income tax. So what is the meaning of direct tax? Direct tax means the burden of tax. Actually tax is a burden. Is it not? So the burden of that tax cannot be shifted from one person to another person. For example, suppose government imposed 10,000 rupees as income tax on individual A. So this individual A cannot shift this 10,000 rupees tax burden to other person. That means he cannot shift to individual B. Okay, this individual A need to pay this 10,000 rupees. Whereas in the case of indirect tax examples are sales tax, then excise duty, customs duty, VAT, value added tax, etc. And now onwards, all the indirect tax is merged into a single tax, that is known as GST, goods and services tax, that we can discuss later. Okay, so this, in the case of indirect tax, this burden of tax can be shifted from one person to another person. For example, sales tax is an indirect tax. Sales tax. Actually, this sales tax is imposed by the government on seller. Okay, but actually who is paying this sales tax? Sales tax is paying the consumer or customer, because the seller is charging this sales tax on the price of the commodity. For example, sales tax is imposed by the government is rupees 1, and previously before imposing sales tax, the producer or the seller sold that commodity at rupees 5. At rupees 5. Now the government is imposed this 1 rupee sales tax. So what the seller will do? He will add this 1 rupee along this price. So what will become new price? Rupees 6. Rupees 6 will be new price, and out of this rupees 6, 1 rupee is included as sales tax. Okay, so this burden of tax is shifted. The seller is shifted that burden of tax to the customer or consumer. So in the case of indirect tax, the burden can be shifted. Here we are discussing about indirect tax. Okay, so when the government sector is introduced in the 3-sector model, then if the government is here, the producer is produced rupees 50 rupees commodity, so domestic product at market price was rupees 50. At the same time, domestic product at factor cost also was rupees 50. DPFC is 50 and DPMP also 50. So when the government introduced into the system, then government will charge indirect tax on producer. For example, rupees 10 is added as indirect tax. Rupees 10 is added as indirect tax. Then what will happen to domestic product? So this 10 will be added along with the price of the commodity. So previously domestic product was rupees 50, and now it will become, domestic product will become 60. Along this 50, this tax also will add. Okay, so here domestic product is rupees 60, and here domestic product at factor cost it is rupees 50. 60 and 50, both are different. Okay, so that is the role of tax. At the same time, next one, that is subsidy. If the government is providing subsidy to the producer, if the government is providing subsidy means it may be financial aid or subsidized electricity is providing at a low rate. Okay, that is subsidy. So if the government is providing subsidy to the producer, then automatically cost of production will decrease. What will happen? Cost of production will decrease, and the value of domestic product will decrease. Value of domestic product also will decrease. Okay, so this was the domestic product at market price initially, and now the government is provided 5 rupees subsidy to the producer. 5 rupees subsidy to the producer. So as a result of giving this subsidy, domestic product at market price will become, previously it was 50 and government provide 5 rupees subsidy, then price will decrease and now it will become 45. Domestic product at market price will become 45. So if the government is imposing tax on producer, then domestic product at market price will be greater than domestic product at factor cost. That means DPMP will be greater than DPFC if the government is imposing tax. If the government is providing subsidy, then DPMP, domestic product at market price, will be less than domestic product at factor cost. Okay, now we need to equalize domestic product at market price with the domestic product at factor cost. Okay, with an example we can. So listen here. So in 2-sector model, domestic product at market price it was rupees 50 and domestic product at factor cost it was rupees 50. Both are equal, no doubt. And in 3-sector model, government is introduced. As a result, government imposed indirect tax of rupees 10 on the producer, and the subsidy, government provides subsidy of rupees 5 to the producer. So when the government imposed tax onto the producer, what happened to domestic product at market price? It will increase. And when the government provide subsidy to the producer, what will happen to the domestic product at market price? It will decrease. So present domestic product at market price is equal to rupees 50. That means previously he produced rupees 50's commodity and government imposed a tax of rupees 50, sorry, rupees 10, then 50 became 60, 50 plus 10, that is equal to 60, and at the same time government provided subsidy of rupees 5 also. That 5 should be reduced from rupees 60. So 60 minus 5, that is equal to 55. Got it? 55 is domestic product at market price. Now we need to calculate domestic product at factor cost, or we need to equalize this domestic product at factor cost with a domestic product at market price. So here domestic product is at market price is increased due to imposing of tax. So what we can do? That should decrease. So we need to subtract that indirect tax from our domestic product at market price. Okay, next one, here the government is provided subsidy, as a result domestic product at market price is decreased. So we need to increase, so we need to add that subsidy. So domestic product at factor cost is equal to domestic product at market price. Then we need to subtract this indirect tax minus indirect tax plus subsidy, minus indirect tax plus subsidy. So as per our example, domestic product at market price is equal to rupees 55 minus indirect tax is equal to 10 plus subsidy is equal to 5. So 55 plus 5 is equal to 60, 60 minus 10 is equal to 50. So domestic product at factor cost is equal to 50. So in order to convert domestic product at market price into domestic product at factor cost, DPMP into DPFC, what we can do? We need to subtract indirect tax and we need to add subsidy. So DPMP minus IT, indirect tax plus subsidy, that is equal to DPFC. Otherwise this minus indirect tax plus subsidy, that we can write it as net indirect tax. What is net indirect tax? So how we can calculate net indirect tax? So net indirect tax is equal to indirect tax minus subsidy. Indirect tax minus subsidy. So as per our example, how much it was indirect tax? Indirect tax was 10 and the subsidy it was 5. So NIT, net indirect tax, is equal to 5. And after calculating this net indirect tax, then we can easily calculate domestic product at factor cost. That is, domestic product at factor cost is equal to domestic product at market price minus NIT. No need to bother about IT and subsidy. Just to subtract NIT. How we can calculate this NIT? NIT is equal to IT, indirect tax minus subsidy. So DPMP, it was 55 minus NIT. NIT is how much? 5. That is equal to 50. So keep in mind, for converting MP into FC, market price into factor cost, MP into FC, what we can do? Just subtract NIT. Subtract NIT. Then question is, how we can convert FC, factor cost, into market price? Factor cost into market price. Then just opposite, plus NIT. Plus net indirect tax. Okay, MP into FC, that is minus NIT, FC into MP, that is plus NIT. So listen here to an important topic of this chapter, that is aggregates related to national income. Okay, so here we are going to discuss different aggregates, different concept related with national income. So firstly we are going to discuss aggregates related to domestic income or domestic product. So from in previous lecture or in previous part we discussed that from here onwards instead of using income we will use product. Okay, so first concepts are GDP MP, NDP MP, GDP FC, NDP FC. GDP MP means gross domestic product at market price. This is net domestic product at market price, and this is gross domestic product at factor cost, and this is net domestic product at factor cost. So before analyzing the definition of this concept, firstly we can refresh our previous learnings. That is, first one, in order to convert gross into net, what we can do? We need to subtract depreciation. Then net into gross plus depreciation, MP market price into factor cost. How we can? By subtracting NIT. Then FC into MP, just to add NIT. Then domestic into national plus NFI-FA, and national into domestic minus NFI-FA. So the first concept, that is GDP MP. What is GDP MP? So it is gross domestic product at market price. In simply, GDP MP is the sum total of or the money value of all final goods and services produced in a country during a particular accounting year. Otherwise, GDP is the money value of all final goods and services produced within domestic territory. This is domestic concept, so we need to add domestic territory. Produced within domestic territory during an accounting year. That is GDP MP. Okay, next one, that is NDP MP, net domestic product at market price. So what is net domestic product at market price? That is, it is the money value of all final goods and services produced within the domestic territory of a country during an year, excluding depreciation. So in GDP MP, depreciation is included, whereas in the case of NDP MP, depreciation is not included. Then the question is, how we can calculate NDP MP from this GDP MP? So what is the changes happen? This G is changed into N. How we can change it? By subtracting depreciation. So NDP MP is equal to GDP MP minus depreciation. GDP MP minus depreciation. Next one, how we can calculate GDP MP from this NDP MP? So NDP MP plus depreciation. Got it? NDP, GDP MP minus depreciation, then GDP, NDP MP plus depreciation, plus and minus. Okay, next then, that is GDP FC. This is in the form of factor cost. What are the factor costs? Compensation of employee, rent, interest and profit. Okay, so GDP FC means it is a sum total of factor cost or sum total of factor income which is generated within domestic territory of a country, including depreciation during an accounting period. Okay, so GDP FC is equal to sum total of factor income. What are the factor income? Compensation of employee plus rent plus interest plus profit. Then including depreciation. So we need to add depreciation also. Then only we will get this GDP-FC. Okay. So compensation of employee plus rent plus interest plus depreciation, that is known as GDP-FC. Next one, that is what is NDP-FC. What is NDP-FC? So NDP-FC is the sum total of factor income which is generated within the domestic territory of a country. Sum total of factor income. What is the sum total of factor income? Compensation of employee plus rent plus interest plus profit. Here this is net concept, so depreciation is not included. Okay, so NDP-FC is equal to compensation of employee plus rent plus interest plus profit. The next question, how we can convert this GDP-FC into NDP-FC? So NDP-FC is equal to, from this GDP-FC we can calculate GDP-FC G into N. How we can convert? That is minus depreciation. Next one, how we can calculate GDP-FC from this NDP-FC? So NDP-FC, that is this N into G. N into G means plus depreciation. Plus depreciation. Understood? So that is NDP-FC and GDP-FC. Got it? So now we can discuss an important topic of. Okay, here it is GDP-MP, NDP-MP, NDP-FC, GDP-FC. So for discussing this flowchart, keep in mind this concept again. G to N, that is minus depreciation, N to G, that is plus depreciation, MP into FC, that is minus NIT, FC into MP, that is plus NIT, D to, that is domestic to national, that is plus NFI-FA, net to, that means national to domestic, that is NFI plus minus NFI-FA. So these two are not required for completing this flowchart. These four, 1, 2, 3, 4, these fours are required. Okay, because we are discussing only about the domestic concept. So first one, that is conversion of GDP-MP into NDP-MP. GDP-MP into NDP-MP. So which letter is changed here? G changed into N. Is it now? D and D are common, P and P are common, MP and MP are common. So how we can convert this G into N? G into N means minus depreciation. So if we subtract depreciation from this GDP, then what we will get? NDP-MP. Next one, how we can convert this NDP-MP into GDP-MP? Just opposite of this one. Here it is minus depreciation, it will become plus depreciation. It will become plus depreciation. Understood? Next one, that is GDP-MP into GDP-FC. So which letter is changed? G and G common, D and D common, P and P are common, MP and FC. So how we can convert MP into FC? MP into FC means minus NIT. So in order to convert GDP-MP into GDP-FC, we need to subtract NIT. Then opposite, GDP-FC into GDP-MP. FC into MP, that is plus NIT. Plus NIT. Next one, GDP-FC into NDP-FC. Here GDP-FC, all things are common, the change is only G into N. So how we can convert gross into net? By subtracting depreciation. So minus depreciation. Then NDP-FC into GDP-FC. How? Plus depreciation. Next, NDP-MP into NDP-FC. NDP and NDP same. but the difference is MP into FC. How we can convert MP into FC? MP into FC means minus NIT. So minus NIT. Then FC into MP, just opposite, plus NIT. Understood? G to N minus depreciation, N to G plus depreciation, MP into FC minus NIT, FC into MP plus NIT. Okay. Next one, that is how we can convert GDP FC into NDP MP. GDP FC into NDP MP, and how we can convert NDP MP into GDP FC. First we can convert GDP MP into NDP MP. Okay, so what are the changes is happening? GDP FC and NDP MP. So G is changing as N. Next one, FC is going to change as MP. Firstly, we can convert this G into N. How we can convert G into N? Minus depreciation. So now we got N, G into N, gross into net, that is minus depreciation. Next one, FC into MP. How we can convert? FC into MP plus NIT. FC into MP, that is plus NIT. Okay, so if we subtract this minus, if we subtract depreciation from this GDP, it will become NDP, and if we add NIT along this FC, it will become MP, that is NDP FC. Next one, that is conversion of NDP MP into GDP FC, just to opposite. Firstly we can change N into G. How we can change N? Net into gross plus depreciation, then MP into FC. How? Minus NIT. Next one, that is conversion of NDP FC into GDP MP. NDP FC into GDP MP. So firstly we can convert N into G. How we can convert N into G? Net into gross, that is plus depreciation. Then next one, FC into MP. FC into MP, that is plus NIT. Next one, that is GDP MP into NDP FC. How we can convert? First we can convert G into N, gross into net. How we can convert? Minus depreciation. Next one, this MP into FC. How? Minus NIT. Okay, so these are the concepts related with domestic product. Got it? And for converting these things, you have to remember these formulas. Okay, just note down this formula in your notebook. And today we can wind up our session through this analysis, and tomorrow we can come back with a new topic, that is aggregates related to national income, that is national concept. Today we discussed domestic concept, and tomorrow we can discuss national concept. So just to revise in your home and stay safe. Thank you. So now we can discuss this flow chart.